Good afternoon. I am Ilan Handelsman from Raintree Financial Solutions. And today we're going to be hearing from Jason Gioga, Chief Investment Officer of Avenue Living Real Estate Core Trust. I've been excited about this call. I'm sure we are all going to learn a lot. Jason, I'm going to hand it over to you. But just before you get started, for everybody who's on this call, in the bottom of your screen, there is a Q&A tab. Please type in your questions, your thoughts, your comments, and we will get to them throughout the presentation. Thanks so much, and over to you, Jason.
Thank you very much. Good morning, good afternoon, everybody across the country. My name is Jason Gioga. I serve as the Chief Investment Officer for the Avenue Living Group of Companies. I'm here today to talk to you about our Avenue Living Core Trust offering, which is our largest offering, our mothership rooted in multifamily residential assets. So without further ado, let me take you through the presentation. Just want to start with our standard legal disclaimer, which basically is here, and this presentation will be made to you, available to you. So Avenue Living is a very interesting company that's now 15 years old. It has been routed on the principles of investing in the everyday. So today we are a $2 billion asset under management organization. I mentioned we're now 15 years under our belt as a track record. We serve 19 different markets, and we have over $700 million in equity managed. When we talk about the focused on the everyday, it comes down to the assets that we buy. We tend to buy the assets that are hiding in plain sight, the assets that you're driving by every single day that you typically would not really notice. And arguably why we invest in them is because they tend to be more favorable from a purchase price and return horizon than some of the more broader consumer preferences out there. As I mentioned, we're now a $2 billion plus organization, but very humble beginnings back in 2006. The business was routed on a number of different tenets that I can explain to you really quickly, but it came down to the fact that we had two co-founders who were looking to buy a multifamily asset in Calgary at the time, to be honest. And this was back in 2006. And if any of those on the call here from Alberta, you would remember the Alberta boom time, and really quickly recognized that they were priced out, that their cost of capital was too high relative to the yields that the real estate was offering in that Calgary to Fort McMurray corridor. So they ended up looking more further and further afield, and ultimately chanced upon an asset in Brooks, Alberta, which had some really strong fundamentals to it that still hold true to this day. Number one, the owner operator of that asset was mom and pop, and mom and pop were basically renting that asset out at rents that were about half the price of the similar asset in Calgary. Second thing was that the market of Brooks, Alberta, although not on the map for a lot of people, was actually a very big trading hub that served the communities around it. And it became our early trappings of our target markets were to find markets that were agnostic to industry and truly focused on diversification of cash flows through various services that they provided to the region around it. So a place like Brooks, where they had 12 or 13,000 people living in the market, they ultimately had a trading area of about 3 to 4 times that. So it made it a sticky populace. The third piece of the business was the resident. Who was our resident? Who was our customer? Who was paying us rents? And what we quickly identified back then, it was the workforce housing socioeconomic profile. They were the renter by necessity, not the renter by choice. And they ultimately were a group of residents that were making $15 to $50 an hour, but could afford to pay rent probably higher than what mom and pop were charging them, but never really were tasked with it because these assets were starved for investment. So ultimately, we bought our first asset back then and consistently grew through the backdrop of 3 recessions, including COVID, and have now built this beautiful organization that we know today. How did we do this? We did it through 5 mandates, as I mentioned, Core Trust being our mothership and our original mandate, which is our multifamily mandate. We also have an Opportunities Trust, an Agricultural Land Trust, which is on shelf at Raintree, a U.S. Real Estate Trust, and our mini mall storage properties. All of that combined now amounts actually as of today to about $2.3 billion. So the core trust, real humble beginnings as I just described to you, and really focused on the fact that we could consolidate the mom and pop everyday assets into an institutional quality offering for our residents. And how we do that, and how do we be wide in the low density specialist? It's through our vertically integrated real estate platform. And what I mean by that is when we bought our original asset back in 2006 or 2006, what we recognized is that if you try to give it to a third party to manage, you lose your value proposition as an investor. An owner operating managing style, as in operating it yourself, allow you to capture the maximum part of that value chain. So today, fast forward, we're a workforce of over 400, 500 people in 4 different entities. Our Avenue Living Communities brand, which is what I'm wearing today as our t-shirt, which is a vertically integrated property manager. Our Avenue Living Asset brand, which is our robust team of investment professionals across our Calgary office and beyond, who are focused on raising capital and creatively deploying capital. Our Global Logistics Solutions brand, which is our supply chain management team. They anchor our relationship with Home Depot and others to ensure that we can procure supply at the best prices. And our Strategic and Creative Services brand, which is our full service in-house marketing, who allows us to be able to put together presentations like this today for our stakeholders, but also allows us to have front and center communication with our residents, most importantly, because we have over 25,000 of them living in our ecosystem. I talked a little bit about what we buy. Let me show you as an illustration. We're not out there buying the shiny new Class A building. We just believe that asset has its own buyer profile for it. And we believe that the upside to those assets are very limited based on that buyer profile. On the other hand, when we look at Class B and C assets, the lower stock, the lower rent per square foot, we find that affordable workforce housing category to be a very strong asset class. And it is still yet to be consolidated across the country. And what do I mean by that? If I take the top 20 players in real estate, including Avenue Living across the country, we still only represent 30% of the universe. The balance of the real estate in the Canadian landscape is owned by mom and pop, small family investors. It's unconsolidated. There is more exasperation of that unconsolidation at the Class B and C class unit types than there would be in the A class. So if we were out there building a business to manage B and C, which we have done successfully, and we can go consolidate from a wider audience of customers, as in the mom and pop investor, then our road to run is much longer than if we were focused on the shiny, bright, and new. And what we get with that is an opportunity to buy at a higher yield, to buy below replacement cost, and be able to put in capital expenditure to de-risk our position. So overarching, it's a very exciting opportunity for us. I talk about workforce housing. Workforce housing is really the concept and the backbone of our tenant populace. This is the populace that is making between 60 and 120% of the median income, or $15 to $50 an hour. They are what we consider the rent by necessity group of Canadians that represent 30 to 40% of the populace. And what we've done is we've focused our business and geared towards the essential workers, towards this working class folk, to ensure that as we build a business model, all of the bells and whistles that we build into our business model are servicing that customer. Whether it be the products we choose for their suite finishes, to how we build their common areas with the security protocols we put in place, to how we deal with the exterior of the buildings, to how we engage with them on social media or through our call center or through the building and through our team. It is all rooted around knowing our customer and providing that consistent service offering. And that allows us to then make the right investment decisions. Market diversification, as I mentioned, we started our business in tertiary markets like Brooks, Alberta, and over the course of time had spread out across the prairies into our jurisdictions and balance the toggle between secondary, tertiary, and primary. And today I'm proud to say that our primary markets are over 51% of our portfolio, with the balance of it being in the secondary and the tertiary market. And when I say the primary, Calgary, Edmonton, Saskatoon, Regina, Winnipeg, which in those markets, we focus again to our knitting on the essential workers of those cities. For those of you who've been to Calgary, our assets are near the airport or near the regional shopping mall and hospital, because that is the tenant profile that we are looking to live with us. In Edmonton, we've got assets near transit stations so that people can get to work easily. So really, at the end of the day, this is really how we've built our business to focus on a demographic. Just demonstrating the fact that when we are across the market, this is our positioning. In the primary markets, we have pretty reasonable size, single digit percentages of the universe. We own 9% of Saskatoon. We own 4% of Regina. But when we look at the secondary and tertiaries, we are very successful in consolidating those markets. We've successfully consolidated 49% of Brooks, Alberta, where we started with our first asset, or 56% of Yorkton. But you can see that we are now the dominant player in those secondary and tertiaries, and we are building our business now more into the primaries and continuing in the secondaries and tertiaries for that cash flow. Population growth, just to showcase that too, because I get a lot of questions about going into these small regions. But you can see that most of our markets have continuously positive population growth. And furthermore, some of them were in well above the national growth average. So it just gives you that stickiness of new inbound residents. The Avenue Living Standard, I talk about CapEx. What you can see here is that we really offer two predictable standards to our residents. One is a partially renovated classic unit, which would have new flooring, new painting, a painted kitchen, and new appliances, to a fully renovated, gutted, and replaced asset class called the Premier. And throughout our buildings across our universe, our 10,000 doors, we are high grading our asset base with classics and premiers across our jurisdictions. Other things that we do that are unique to Avenue Living in our offering is we launched an ancillary revenue program. So we live in jurisdictions where gross rent is very common, whether that be across Canada or in the prairies. And it was an opportunity for us to unhide the hidden when it came to how landlords and tenants interact. So we created fees in our offering, such as our administration fee, our environmental fee, our security charges, so that tenants who wanted to live there had to pay those fees. We also started to offer some service offerings that made them optional fees for convenience, such as our utility program, parking designated, our insurance or our tenants insurance program. But ultimately, all of these fees combined have now grown into a major reoccurring revenue stream for us, from a standing start to now over $500,000 a month in revenue, or over 10% of our gross revenue. So it's been a very successful program for us. As you can see here, we've had a significant amount of growth over the years. Our revenue, not only on a total top line basis, but on a per door basis, has continued to grow and drive in the right direction. And really, it's a combination of acquisitions and organic growth, so same door performance. So it's quite exciting to see that our overall 14% revenue growth in 2020 and 7% on a per own basis or per unit. So just measures efficiencies of our offerings. Our NOI continues to grow in the right direction. It's been very strong. COVID, I think I can't have a presentation without talking to you about COVID. Ultimately, COVID was an uncertain time for all of us in the world. And when it came to being in the business of running the rental apartment business, we went into COVID with a lot of uncertainty. I think the market painted a pretty bleak brush of what could happen. We charged forward with our C-suite and our senior management team, being leaders across our region, and made sure that all protocols were put in play or emphasized to ensure that we were in command and control of our business. And what did that lead to? while we did things like set up our payment task force, we set up our community relief teams, we worked with a number of our residents to help them get onto weekly payments, help them get onto CERB if they needed it. We really got in front of the communication with our stakeholders to ensure that it was business as usual. And that ended up allowing us to actually have up nodes in our collections. It allowed us to continue to service work orders like changing light bulbs. It allowed us to continue to generate leases and renewals, or having a good conversion rate of all the leads that were coming in. And we did have people work from home during the time, and continue to have people working from home for safety reasons, but we still managed a service standard. Our call center, which would be employees who typically would take transit to the office, were required to work from home, and still we managed to have a high 90s call center service level, which was really exciting for us. Some risks have been laid out here, but I will now take this opportunity. I've got in here the senior management team. It's not just the story of myself or our co-founder Anthony, but it's a very broad team of industry and professionals. We've got independent trustees within our board, and then I've got some case studies in this deck. So let me take a pause here for any Q&A that you may have at this point.
Thanks, Jason. Good spot to pause. For those of you who are attending this call, please click on that Q&A box and jot down any questions that you might have. I'll get to them. Jason, could you just go back to slide 16 for a moment?
Slide 16, yes. Give me a second. Sorry, I don't have a, yes, there it is.
There we go. So can you explain what how the environmental recovery, what that is and how it works?
Yeah, so environmental recovery is just another ancillary charge that we provide applicable to all units. And it's basically a cost to offset the charges that we had resulting from our garbage collections and some of those things that we do with the various municipalities. So it was just a recovery on something that we flow through to the tenant.
Oh, got it. Okay, that makes perfect sense to me. So in terms of geography, why not BC and only one in Manitoba? You seem to be very concentrated in Alberta and Saskatchewan.
Yeah, I think a couple of reasons there. So I think that we have focused our knitting on Alberta, Saskatchewan, simply because we see the opportunity in our backyard. We look at the land mass in Alberta and Saskatchewan. It's probably the equivalent of Western Europe, and it still only has 5 million people. So where we lack population density, we need infrastructure, and infrastructure requires housing to support that base. And so there's a lot of road to run. Furthermore, there are no rent controls in Alberta and Saskatchewan to the extent that they are in Ontario or the British Columbia markets, which has allowed us to know our territories very well. And to a lesser extent, we participate in Winnipeg. And then the other piece of it is that we find that the Ontario markets in BC are quite oversaturated with investment, driving prices quite higher. So when we look at that, our goal and objective is to really focus our business on Middle Canada, and recently expanded that into Middle America, where we have a lot more road to run if we can get ourselves comfortable in low population densities.
Got it. Thank you. How has the increase in the price of lumber impacted the value add projects for the Core Trust?
Great question. We have a pretty disciplined supply chain program that has allowed us to use our buying power to keep costs at bay. But where we have had circumstances where prices have gone up, we try to see if we can spec out alternative solutions. Fortunately, we're not in the development business, so the impact of lumber directly to us is not as high, but we have seen that certain materials have gone cost higher today than they have in previous. And we've just been trying to use our opportunities in our supply chain to procure things at better prices.
Okay, great. Let me just see if there's anything else here for now. Can you talk a little bit about the call center service levels? How do you define those service levels? You said they're all in the high 90s.
Yeah, so a service level, and I actually have this in the slide here, if I can just pull it up, is really it's basically the amount of calls answered through the call center within 1 minute. And so for us to have 98% of our calls answered within a minute, it tells you that we're still maintaining a good service standard for our customers.
That's outstanding.
Absolutely.
Thanks.
Run a pretty tight machine up there.
Okay, great. Thank you all for your questions so far. Please keep them coming. Okay, Jason, do you want to keep going with the presentation for now?
Yeah, I think there was really not much more to add to the presentation. I wanted to just showcase a few of the slides on some of our programs of what we do when we do value add. And here's an example here called Greystone Manor. It's an asset that we purchased a few years back, and we went in to Regina and bought it for about $2.5 million. We identified with this asset was that it lacked curb appeal, and the current state of it required some common area curb appeal and some renovated suites. And so what we did is we went in and we did new siding. We refreshed the look of the building, and you can see the pre-caps versus post-cap. And ultimately, we're able to just make the asset better. By doing that and investing the $400,000, we actually added a fair market value bump of about $1 million. So the ROI on our investment was quite sizable, the incremental capex that we looked at, which was at 150%. And you can also see that the rents went from $800 to $1,050. So we had a pretty sizable rent increase as well during that time.
Great.
Shannon Villa, another one that we had in Edmonton, a 24-suiter. Again, very similar. And what's really important to notice here is that we hit a really nice ROI. We invested $250,000 in this building. Again, you can see we did exterior work, landscaping, paving, the whole shebang to improve the curb appeal as well as common areas. But we did not get a cap rate compression. What I mean is when we create value, it's based on creating value through improved income, leaving the yields the same. So when I say we added $500,000 in fair value, it's completely correlated to the pre and post capex rents, not correlated to just the market changed in our favor. That's not how we built this business. We create our own alpha. And then finally, Hames Farms. It's an asset that we had purchased last year in Calgary, an asset that I really just gives you an idea of the type of assets that we're buying in terms of low density housing. But this is a asset that we purchased at about $36 million from a vendor who was Toronto based, who was basically selling their last group of assets in the market. And so as a result, we ended up buying it right, buying it at the right time, and had a very significant discount to what the market value is when we bought it, just based on our opportunity there. We are working on some upgrades to that asset, some common area upgrades, as well as some exterior envelope upgrades. So we're really excited about it.
Great. Do you have a slide that just summarizes the terms of the offering?
I don't think they put one in here, to be quite honest with you, Ilan.
Okay. Do you want to just cover off the terms of your offering for those?
Yeah. So we have a A-class unit. It targets a return of anywhere between 8 to 12%. I think the NAV currently is about 1030 or so. And then on top of that, we have monthly closes, and ultimately it's RRSP, TFSA eligible. There's an offering memorandum. Our offering memorandum is actually going up and down right now as we speak. So we're probably about 7 days away from having that out there in the market again. And yeah, it's been very well received. As I mentioned before, we've raised in this mandate north of $400 million in the last couple of years, and it continues to accrete great results.
Excellent. Jason, what are you most excited about?
I am most excited about our pipeline of acquisitions in front of us. We are actually working on over 2,000 doors at the same time right now of acquisitions, some of them up in Edmonton, some of them here in Calgary. We think we're going to be able to chew through all of that over the course of the next 2 quarters, and it's going to really change the shape of this organization.
Fantastic. What keeps you up at night?
Oh, I've got three little kids. They're 5, 4, and 2. So I can tell you that that's part of it. But yeah, look, generally it just comes down to being in control of our business allows me to sleep well in the evenings. I am candidly in every facet of this business, shoulder to shoulder with the C-suite here. We meet every single day, 9 a.m., all of us talking about the risks of the business, the opportunities, the threats, the challenges that everyone's facing, and it allows us to steer in the right direction. So I can tell you that there are thousands of things that keep me up at night, but when I wake up in the morning, I have a team to go to make sure that we are all in the right direction.
Great. It is indeed important. In real estate, we say location, and in private investing, we say management team. And knowing that there is a disciplined practice that you all subscribe to on a daily basis, I think it speaks very strongly for who you are and what you're doing and why you've been as successful as you are so far. Jason, can you talk about your plans for exit? Do you anticipate selling the entire portfolio someday or piecemeal? How are you going to approach an exit?
I would tell you that the journey of consolidating these cash flows has been a challenging one because it's iterative, right? Every transaction we do, it's one in a row, and you're measured by success on every single transaction that you do. If there were ever to be an exit contemplated, it would have to come at a very sizable price point for us to look at that. But really what we want to be able to do is offer investors liquidity along the journey based on their own circumstance to share in the upside on that journey. And if it's the right time for them to stay in, great. If they need to leave, we offer that liquidity. As far as the founders and their equity is concerned, they seem to be very comfortable having it in this business every single day. They have over 250 million of it in here. So I can tell you that there's no real contemplated exit here. It's just continue to do more of the same. And then as time goes on, hopefully everyone gets rewarded for the larger piece of the pie that we've ended up building.
Great. Can you talk a little bit about how Avenue Core Trust uses debt leverage?
Yeah, absolutely. So we borrow through all the major banks in Canada and beyond. We are fairly conservative with our leverage. We ensure that we stay below a 60% threshold of leverage, which we believe is our optimized capital structure. Real estate debt goes up to 75% typically. And yeah, we monitor the yields that we have against the duration of those loan amounts to make sure that our treasury function is functioning well and that we don't put the organization at any major significant risk in the short term, whether it be through debt maturity or interest rate risk.
Okay, great. Ladies and gentlemen, this is the last call for questions. So far, I've really enjoyed myself. If you have any last questions, please pop them into the Q&A box now. So why you've spoken so much about going after the working class Canadian who need to rent their housing. What is it that gives you so much confidence through different economic cycles? Coming out of COVID, nobody really knows what the economic tail of this is going to look like and what the recovery is going to look like. Why is it that this particular segment of the asset class appeals to you so much?
Yeah, I think it comes down to the resiliency of our resident base. We house over 25,000 people in our ecosystem. And what we found is when the going gets tough, this group of people stay tenacious and resilient. And that then flows through in the cash flow and the predictability of that cash flow to us. So we take a look at COVID, essential workers, whether they had to go on CERB, whether they had to go on leaves, whether they got laid off, they tended to be resilient and tenacious and bounce back even stronger. And as a result, this low skill, semi-skilled worker, this wage band, it is more predictable on the masses than if we were in a circumstance where we housed a whole bunch of millennials who went home to mom and dad, as an example. So we feel very defensible in this position.
Great. With that, Jason, thank you very much for your time today. I appreciate the presentation. And if you, as somebody listening to this call, have any questions, please contact your Raintree advisor. And we look forward to seeing you all soon again. Bye for now.
Thank you.